Imagine you're handed 340 pages with 11 minutes before a meeting where you'll be expected to have an opinion. Most people start on page 1 and keep going in order, underlining things, because that's what reading a document usually means. A good analyst doesn't. He skips the opening letter without reading a full sentence of it, skips the photographs of a factory floor lit like a perfume ad, skips the 2 pages of language built to make you feel calm before you've learned anything. 4 minutes in, he stopped twice. Not on the pages that summarize the company, on 2 pages most readers would never think to look for, because neither one was written to be found. And this isn't really an unusual problem. Someone gets handed a filing, told to get up to speed, and quietly wonders which 300 pages actually matter. So what did he see in 4 minutes that a room full of people with the same document didn't? Here's what you've probably absorbed, without anyone quite saying it out loud, about what it means to understand money. That it's a volume problem. Read the books, subscribe to the newsletters, watch the confident people explain what the market is about to do. Follow the earnings calls, the upgrades, the commentary stacked on commentary. And at some point, the assumption goes, all of that raw material resolves into understanding, the way sediment eventually becomes stone. It doesn't work like that. And the failure isn't laziness, it's architecture. Most of that material is optimized for consumption before interpretation. A headline is built to be read in half a second. An earnings call is a performance, rehearsed by people whose job that quarter is to sound reassuring. Almost none of it was built to survive one simple question. Is this the information that determines what happens next, or just the information that got placed in front of me first? Which is the quiet, uncomfortable thing about watching someone do this for a living. He isn't smarter than the room. He decided before he opened the cover what he was allowed to ignore. If you had 4 minutes and this document in front of you, where would you look first? Revenue, probably, or growth, or profit, the numbers built to be the headline. He skips all 3. Page 14. Not the page with the story, the page with the plumbing. Cash moving in, cash moving out, and the gap between them. Because that gap is the only honest measure of how much room a company has before decisions start getting made out of fear instead of strategy. For a second, it looks like the answer. It isn't. A company can be sitting on a healthy cash balance and still be walking into trouble if that balance is a photograph instead of a forecast, a snapshot of one Tuesday afternoon instead of a trend. The cash tells you the company can breathe right now. It says nothing about when the air runs out. So if the company has cash, what's the problem? The next stop isn't a bigger number. It's a calendar. A section with a name specifically boring enough that almost nobody reads it. A debt maturity schedule. Not how much is owed. When. Imagine a company that's genuinely profitable this quarter. With a loan coming due in 8 months, it planned to refinance easily, back when refinancing was cheap. The profit is real. The plan was reasonable at the time. Neither fact changes what happens if borrowing gets more expensive and the calendar doesn't move to accommodate it. The company doesn't become less profitable overnight, it becomes fragile overnight, in a way the income statement will never show you, because the income statement isn't tracking time. The maturity schedule is the only page in the document that is. Profit describes where the company has already been. A maturity wall describes a future you can actually put a date on. The numbers so far appear to explain themselves. Cash is fine. Debt is manageable, mostly. The story holds together. Third stop, and it's not a figure.
It's a name tucked into a footnote, attached to a compensation structure that rewards a specific outcome by a specific date. Someone whose bonus depends on the weather report sounding a little sunnier than the forecast actually is. Nobody has to be lying for this to matter. You don't need deception to get distortion. You just need incentives. This isn't really a CIA secret. It's a general principle of intelligence analysis. When you have too much information, the advantage isn't seeing more of it. It's knowing what deserves your attention. A recurring discipline in intelligence work is treating most of what's placed directly in front of you as either irrelevant or arranged to be persuasive, and going looking specifically for the material that wasn't written with you in mind. A quarterly filing isn't a classified cable, but it is structurally written by people who'd prefer you stop reading after the part they wrote first. He wasn't reading faster, he was filtering harder.
Input filtering. Deciding before you start what you're not going to read. Friction mapping. Hunting for the 2 or 3 places the whole structure is most likely to fail under pressure. Put together, that's the method. Not knowing everything about a company, knowing exactly where it's allowed to break. Here's where it gets tested, because the title promised any market, not one filing on one desk. So imagine a company everyone's already talking about. The chart that only goes up, the user numbers that keep doubling. A piece of technology so new that half the coverage is just enthusiasm wearing the clothes of analysis. Run the same 3 questions. Where is the actual cash? Not the valuation, not the funding round, the cash. What deadline or dependency could break the story if it arrived a year earlier than the narrative assumes? And who is rewarded, specifically, by how long you keep believing the version currently being told? You don't need the whole prospectus for this, 90 seconds, and the discipline to skip the part that was written to be read first. The hype doesn't disappear when you ask it, it just stops being the only voice in the room. Not a verdict, not a prediction, not a reason to buy or sell anything. Just 3 questions strong enough to sit next to the excitement instead of underneath it. Back to the filing, because that's where this started, and the 11 minutes are almost gone. Look again at the pages he skipped. The letter, the photographs, the language built to make you feel steady before you understood anything. None of it was false, exactly. It just wasn't the plumbing. And look again at what he stopped on. The gap between cash in and cash out, the calendar nobody reads, 1 name in 1 footnote. 3 stops out of 340 pages. The rest of the document wasn't equally important to the question he was trying to answer. He isn't a genius, and he didn't read faster than you could have. He read less on purpose because he'd already decided before the folder was open what the folder was allowed to waste his time with. Which leaves the part that isn't really about him at all. If a method this small can cut through a document that large, then the confusion most people carry around money probably isn't a personal failure of intelligence. It's an attention problem, dressed up as a competence problem. We're constantly given more information, more headlines, more forecasts, more commentary, when what we actually need is a better filter. So maybe the question isn't whether finance is too complicated to understand. Maybe it's why we're so often trained to look at everything except the things that actually constrain the system. Because once you know what can break, you don't need to read everything anymore.